Hi, and welcome back again to Tim Bigham's Options and Volatility newsletter. Taking a look today at a recent trade possibilities on TEVA Pharmaceutical, TEVA, where some big time unusual call buying sets up a few different trades with some big time edge. So let's jump in and take a look. First of all, here is Teva from Monday showing up on the UOA scanner. You can see one of the top ones out there. Over 60,000 options traded versus about 20,000 on average. So 2.7 times the normal volume. You can see IV percentile now at 100%, which means option prices haven't been this expensive in the past year, right? And this is post earnings. So taking a look at the IV, you can see IV absolutely exploded here post all that option buying to the highest level we have seen by far over the past year. You can see from yesterday to today, IV certainly heading higher here. So the reason all because of a huge buyer in the January 19 calls, plus additional buying across the board in the options. So here was Teva before the big call buyer, right, on Friday's close. You can see the January 19 calls trading just under a 50 IV, a little bit less than 8,000 open interest. The January 19-15 sell strangle going for about 77 cents. Fast forward to Monday, right, where we saw over 29,000 of these options trade. IV now almost at 60, right? Remember the day before it was trading under 50, so a huge explosion in IV sets up ideally for a sell strangle, which with the stock dropping 13 cents, right, basically going nowhere in between the 15 and the 19 strike prices, right, that sell strangle jumped to $1.14. The sell strangle, if you sold the put at a negative 25, the call at a positive 31, you'd be about 6 deltas net short on the trade. So certainly not egregiously long or short. Taking a look at the buy right here, here was the buy right before the big call buyer, right? You can see IV on those calls. This time we're looking at the Jan 17, the more at the money calls, right? Trading just under 50 again, right? That buy right before the big call buyer trading at 15.65, which is taken by buying the stock at 16.78, selling a call at roughly $1.13 or so. Fast forward to the day after that big call buyer, you can see IV jumped on the Jan 17s to over 55. You see the stock down slightly, 13 cents, yet the calls up on the day, right? So those calls, which the previous day were trading at about $1.13 midpoint, right, jumped up all the way to $1.23 almost. So those jumped about a dime on the day. The stock down 13. So you have the stock lower, the calls higher, set up ideally for a buy right trade, which has cheapened by over 20 cents simply because you can buy the stock 13 cents cheaper, sell these at the money calls a dime more expensive, right? Get kind of the best of both worlds and follow the flow out there. The delta on these roughly 50, so you're reducing your exposure by half. For those who want to follow the big bullish call buying out there on these January 19 calls in a different way, the put spread basically yields similar results. Here is the day before the big call buying, right? The puts trading at just under a 43 IV. The March going out to March 14-12 put spread trading about 27-28 cents. Fast forward to after the call buying, right? You can see IV exploded across the term structure vol. Now the March 14 puts trading near 50, right? As we said, the day before they were trading more towards 40. So that put spread, with the stock just dropping 13 cents, hardly moving at all, and you're still well out of the money, over 2.5 points, right? You're able to pick up a dime better on that March 14-12 put spread. And then finally, for those who want to kind of capture vol, do it in a defined risk way. Here is the Iron Condor out in March, which is selling a call spread and a put spread both. In this case, I went to a 2-point wide one. You can adjust your strikes and expirations accordingly to your risk return profile. But here was the day before that big call buyer on the January 19th exploded IV, right? So the March 14, 19 sell iron condor, right, buying the 21 call and the 12 put as protection, right, to find the risk, 2 points of risk less the credit received. The day before the big call buyer with the stock at 1678, that iron condor trading just under 60 cents. Then we fast forward to the day after that big call buyer on the close, right? You can see that iron condor, the same iron condor, selling the 1921 call spread, the 1412 put spread. Both of these roughly about 2.5 points out of the money, actually increased in value by 20 cents. So it went from $1.40 net risk, right? You're selling a 2-point wide iron condor for about 60 cents to only $1.20 or so risk, right? Why? Because that big call buyer inflated that IV to extremes here. Once that call buying drives up, we expect IV to drop here and look to take off the trades for some nice gains. So identifies some different trades to either follow the flow or capture the vol, but both the times you're absolutely going out and capturing the vol by getting an edge because the big call buyers, right, drove up IV across the spectrum. So until next time, as always, here's the good trade.